This is how options data predicts big moves. Let's break down what options traders and market makers are really doing going by BBAI's March 20th options chain. First, zoom out. This stock has a 23.7% short float, trades massive daily volume, and carries a beta above 2.4. That already tells you volatility is the name of the game. Now layer in the options data, and this turns into a pressure cooker setup. When you look at the chain, the biggest thing that jumps out is the massive call open interest stacked above price, especially at the $7, $8, $10, and even $12 strikes. That's not smart money hedging, that's retail momentum positioning. These are cheap, out of the money calls, clearly betting on a breakout, a squeeze, or a news driven move. At the same time, look at the put side. There's heavy put open interest down at $5 and $6, which tells you institutions and market makers are protecting downside, not betting on collapse, but preparing for volatility. This creates a classic setup where puts below and calls above form a price trap. And that brings us to the key level. $6 to $7 is the battleground. That's where call deltas start accelerating, put probabilities flip aggressively, gamma spikes, and market makers are most exposed. Right now, market makers want this stock pinned in that $6 to $7 range into expiration because that's where both sides of the options chain decay. If price chops here, retail loses premium and market makers collect theta. But here's the danger zone. If this stock breaks and holds above $7 with volume, everything changes. Those out of the money calls suddenly gain delta fast, forcing market makers to buy shares to hedge, which pushes price higher, which forces more buying. That's the gamma squeeze mechanism. And with nearly 24% of the float sold short, that can quickly turn into a short squeeze. That's why you're seeing so much attention on this name. Retail isn't randomly buying calls. They're positioning for a convex upside event. They're wrong most of the time, but when they're right, the move is violent. On the flip side, if price fails to break $7 and volume dries up, this becomes a slow bleed. Options decay, hype fades, and market makers win. So the play is simple. Below $7, market makers in control. Above $7 with volume, gamma plus shorts start losing control. Sustained momentum, $8, $9, even $10 become realistic purely on mechanics. This isn't about fundamentals in the short term. This is structure, positioning, and forced hedging. And that's why this options chain matters, because it tells you exactly where the pain is and exactly who's going to feel it first.